We're seeing that pullback carrying through to today, the one, of course, that started yesterday afternoon. And, of course, we had worse than expected consumer confidence numbers out of the US last night, and the German IFO Business Confidence Index also disappointing the market yesterday. So a bit of a rise in volatility.
Yes, very much so. I think certainly a rise in volatility and also once again a flight back to supposed safe haven assets. I think what we're definitely seeing is that we continue having this volatility of good news followed on by bad news, followed on by good news, followed on by more bad news. The market definitely suffering from indigestion in terms of trying to look through all the economic data as well as financial results data that come out, and lots of contrasting and conflicting pictures coming out. The latest numbers, as you've indicated, certainly more on the negative side, and the South African markets taking its cue very much from the international markets. So it was not surprising to us that we followed on this morning from the weakness in the international markets overnight.
Of course, the latest bout of risk aversion was really sparked by the US Federal Reserve last Thursday when they raised the discount rates for banks, and that putting a bit of a scare through the markets. Of course, the Fed has been at pains to say that this does not indicate monetary tightening. We do have Fed Chairman Ben Bernanke speaking to Congress today and tomorrow. What do you think the market's looking for from the Fed Chairman?
I think the market is definitely looking for some direction and some sort of certainty. When that discount rate was raised, it certainly indicated to the market that maybe the economic recovery is well on its way and it's on track. And I think that's one of the reasons why we actually saw a surge in commodity prices again, confidence being restored to many of the financial markets. But the sort of business confidence numbers that we saw coming out overnight and the consumer confidence numbers coming out significantly weaker than the market expected clearly shows that the economic recovery is not all it's meant to be. And I think what the market is looking for is for Bernanke to provide some direction in terms of his expectations on global growth, as well as his views on monetary policy going forward. I think if he's indicating at all that the monetary policy will be tightened anytime in the near future, that will be a sign that the economic recovery is on track. If he pulls back from the sort of slightly tighter talks that we'd heard from him recently, that would certainly indicate that the economy is not as strong as has been seen over the last couple of weeks, and I think we might see some further weakness in markets.
Of course, as you said, the South African markets really taking their cue from global markets. Despite some better than expected economic data coming out of South Africa, we had those growth figures out earlier this week, better than expected for the fourth quarter of last year. Consumer inflation numbers out just half an hour ago show that the consumer price index rose by a smaller than expected 6.2% year on year in January. And the market was really looking for a figure of around 6.3, 6.4%. So some good news economically locally.
Yes, absolutely. We certainly had better than expected numbers on both counts, as you point out. Interesting when we look at the GDP numbers that the biggest growth area still came from the global economy. So it's in the likes of our export sectors, our manufacturing production sectors that are very much export driven, our commodity related sectors and so on, where we saw the biggest growth contribution. When we look at internal demand or domestic demand, still very, very poor demand coming internally, which certainly shows that the consumer is still under a lot of pressure. The combination of the better than expected GDP numbers and the better than expected inflation numbers out just half an hour ago certainly indicates to us that it's very unlikely that the Reserve Bank will have room to or will be likely to cut interest rates. But I think because of this picture of the domestic demand still being relatively weak, I think it's also very unlikely that we'll see a hike in interest rates, domestic interest rates, anytime soon. So from an interest rate point of view, we're expecting interest rates to remain flat for the remainder of this year.
How much does this interest rate decision, do you think, hinge on what NERSA decides on Eskom's tariff increases? And of course, we're expecting that announcement any time now, whether Eskom will get the 35% increase that it has asked for the next 2 years. Of course, the market expecting a figure closer to 25%.
That will certainly be taken into consideration, although we know that rate moves is not really going to have much of an impact on inflation brought about by the NERSA decision. I think our general sense is that if NERSA grants Eskom the 35% increase that they're looking for, it's extremely unlikely that the inflation target of 6% will be met anytime soon, which certainly removes all likelihood of interest rate cuts. If the allowance advance or the increase comes in closer to, say, the 25% level, which some market commentators are looking for, there is an opportunity for inflation to actually come within the inflation target. So a very important announcement, something that will definitely influence not only the CPI numbers, but obviously also the PPI numbers very significantly. Lots of second round effects going through into the rest of the macroeconomic scenario in South Africa. And yes, certainly something that will be very closely watched by the market.
And of course, you mentioned the consumer very much under pressure in South Africa. We had results out from Shoprite yesterday. Headline earnings a share up 13.3%. Of course, Shoprite's chief executive, Whitey Basson, saying the Shoprite's in fact benefited from the recession we saw last year because lots of customers shopped down, lots more customers going through the doors of Shoprite. So good news for some of the retailers.
Yes, and I think also good news for the investors that have been invested in Shoprite up until now. Certainly very, very good performance from that share. And we certainly saw the trading down working in Shoprite's favour. We also recently had results out from Woolies, and even when we look at Pick n Pay, for example, results only out later. But when we go back sort of to the trading updates that we saw in about a month ago from many of our retail companies, certainly these have indicated that maybe the December period was slightly better than the market has expected. And I think what we're looking at in the retail sector is that maybe we're seeing the first signs of lightening and some recovery for the retail consumer. Purely just from the Shoprite point of view, great company, great fundamentals, nothing wrong with it, but I think it's all discounted in the price, and at this stage we would much rather be invested in Woolworths rather than Shoprite.
Of course, as we were saying right at the beginning of the conversation, there is more volatility in the markets at present. Of course, there are lower risk alternatives in volatile markets like this. And this is where Nedbank Capital gets to punt itself a little bit. You're launching a new ETF. It's called the BettaBeta Equally Weighted Top 40 ETF. And that launches today, doesn't it, Nerina?
Yes, of course, as far as we're concerned, this is the biggest news story of the day. But jokes aside, yes, you're absolutely right. We do believe that performance is very much about risk management as much as it is about being chasing returns or looking for returns. As we continue to see in our markets, risk really is around us all the time, and it's very much influenced by the commodity price cycle and by the currency volatility. This, of course, is influencing mostly our resources sector. And when we look up at the makeup of our normal sort of free float market cap weighted top 40 index, it is very much skewed towards the resources sector. Almost 50% in fact of that index is resources, and in fact just the two biggest counters, Anglos and Billiton, make up 30%, almost 30% of that index. The new product that we are bringing to market that are launching is the equally weighted top 40, exactly the same companies as your normal top 40, but it has 2.5% in each of the counters in the company, so it gives you the full exposure to the blue chip companies that are always contained in the top 40 index, but always at equal weight, 2.5% in each of those companies. Exactly the same methodology as the top 40 index, same rebalancing dates, everything else exactly the same, but we do believe that it provides a much lower risk alternative to the investor, whether they be a hedge fund or an institutional investor or the retail investor.
Have you looked at how this index would have performed compared to the top 40 going back over the past year?
Yes, absolutely. We've had the performance of the index calculated back to the end of 2002, so a little bit over 7 years of history. And it's quite clear that there are times that this index would outperform the top 40 index, as there are times that it would underperform it, because it depends very much on where we are in the resources cycle and in the mega cap cycle. So we are certainly not saying that this is an index that will always outperform the top 40 index, but what we do find is that it always has a lower risk because of the lower concentration risk that it has and the equal weighting that it has. So on a risk adjusted basis, the return always better in the equally weighted top 40 rather than in the regular free float market cap weighted.